if we're not in recession, we're moving towards one pretty soon,
Mm.
and then I would guess we could see bust. I've been saying we could see it by the end of the year. That'd be awfully fast. And again, people, at least some of the retail people, think bust, and they think it all is something that happens in 2 days.
Mm.
It has to start somewhere, so it could start by the end of the year or in the first quarter. The to all of 2026, if I'm right, is going to be a bust. I mean, and it could carry into early 2027. It'll be fast, relatively fast, kind of like 2008-9 in terms of a downturn. It's not a depression, but it'll feel like a depression. It'll be something worse than a normal recession.
Okay, so it could last a couple of years. You don't see it as a
Well,
longer
I
term
say I
depression.
say 12 to 18 months, and I say my guess is the bear market, the stock bear market, will be 8 to 10 months.
Mm.
It could stretch beyond that, but something like that.
Okay.
And then by mid 2027, we should be coming out of it. The stock market may have come out of it before the end of 26, and then you've got to deal with you for a year or two. Because and it's gonna the reason you come out of it, and the reason I can confidently talk about the other side, even though it's something we haven't seen in 90 years. A bust is not something we've seen in the post World War II era.
Mm.
Um, but I can confidently talk about a recovery and what the recovery will look like, because I think it's inevitable that they will have to print money like they've never printed before to pull us out of this. So I've talked about a $20 trillion QE out of the Fed, proportionally similar out of every central bank because it's global. And that then jump starts with a lag, a recovery that, because of all that money, ultimately turns into the biggest inflation cycle we've had, bigger than the early 80s. And you could see,
Does that go straight back into the same assets, or are people more selective at that stage?
yeah, good question. I think as I've seen through every cycle in my 52 years, every cycle is different leadership. So, you had the energy and the commodities in the 70s. You had housing and things like that. And basically in the 80s, it was consumer growth stocks,
Mm.
the Philip Morrises and the things that were steady growers because rates were coming down, inflation was coming down. In the 90s, it was tech. In the 2000s, it was housing and finance. In the 2000, the post 2008-9, it's been tech and healthcare and things like that. Not so much healthcare anymore. Um, but the next cycle will be commodity driven, industrials and commodities for a number of reasons. Reshoring will be part of it. Um, the need for, we are going to blow demand through the roof for commodities, and we don't have the supply. So there'll be a lot of machinery that'll have to be built to help build more mines, to help look for more oil. You're going to have a capital goods commodity driven cycle. It doesn't mean you won't have AI. It doesn't mean you won't have specific areas in tech that could be winners, but it does mean they won't have the wind at their back of lower interest rates, because rates, I think, will go from zero in the bust to potentially 20% plus by the early 2030s.
Right.
So, so you don't after 2026. Don't think you want to own a bond.
Yeah.
As I say, if you need a fixed income component of your portfolio after 26, you will want to be rolling Treasury bills or be in a money market where you get the instant increases in rates.
That's an extreme roller coaster that you're describing there, and particularly longer end. You're talking about a significantly inflationary environment. You must have some rather large calls then on the metals long term.
Yeah, I do. I think gold can get to 20,000 by the early 2030s, and I say early 2030s. That does not mean 2030. It means could be 2032 or three. I don't know.
Yeah.
But 20,000 for gold and 500 for silver. And again, just like my equity calls, I may be conservative. I don't know.
Yeah, but those long-term calls then, if you're talking about a massive inflationary environment, you might be talking 500 for silver, but a pint of milk costs you $10.
Right,
Is
right.
that what we're talking about
By the
here?
way, the other big one is, I think, and I've been probably the bear on oil since 2022, and correctly so. I turned bearish on oil before we had the the spike up during the Russian invasion of
Mm.
Ukraine, but I stayed with it at 130 and said we're going back to 85. And then once we broke 100, I said we're going to 60. So I've been pretty bearish on oil. I think we see probably 30 in the bust. And then from there, and it could certainly go lower given what happened last cycle, if you remember when it went
Went
to
negative.
negative.
Who
But
knew?
I'll say 30. And from there, I think you could see $500 oil by the early 2030s.
Wow.
So again, as I say, it's a commodity cycle.
Yeah.
Copper could be 20 or more. From it could fall to $1 or $2 in the bust, but go from there to 20. Natural gas might be $50. I mean, I don't know where these things are going to go. What we're going to have is massive demand for commodities because they're going to be needed for building new plants and equipment and all that. Because of that 20 trillion print and probably 50 trillion worldwide, it's gonna goose demand, and we've rationalized down supply, the mining and all that, and search for oil, et cetera. We've rationalized that all down in a period when they were trying to discourage all of that. So if we get that through the roof, like I said, the demand because of the money print can happen within 1, 2, 3 years,
Mm.
whereas the having to build new supply can take 10 or 20 years. So you're going to have a case where you have supply far exceeding demand, and the only thing that can give is price.
And what you're really looking at here is you're talking about central banks and administrations just going back to the same tools that they always have, which is money printing. It's money printing that's getting them into this problem at the moment. We've got debt at $37 trillion in the US, and global debt over 300 trillion. And that it's when we start to feel a bit of pressure on the system, we're going to see more money printing. It's ultimately we'll have a bust because it's unsustainable, but then the route out of that bust is even further money printing, and you think that they can add another 50 trillion to
Globally, yep.
globally. It's just going to be what you're really calling for there is a destruction of the purchasing power of fiat currency globally.
And what I say is I'm not endorsing this policy because it's a disaster ultimately.
Yeah.
I'm saying it's inevitable. What it really is the result of is 80 or 90 years of somebody I said, I don't know, it's sine waves or what. Somebody said it's a buggy whip pattern you're calling for, that each successive cycle coming out of the Great Depression, you had greater excesses up, greater excesses as they tightened down to combat inflation or what have you, and then that took greater excesses back up. And what we've done is successively cycle to cycle, particularly these last few cycles, is gone to much bigger extremes. That's part of what my parabolic's about, and that you're basically at the end game. The difference between myself and the Austrian camp or the Peter Schiff camp, those guys that say we're down for the count now, I say no because they have the printing press for one more time. Because we'll be in deflation, they have infinite ability to print.
Mm.
They are not wanting to print. Powell is very, very sincere when he says, I'm not going back there. I'm not doing what we did last cycle. And that's part of why we're going to get to what I'm talking about, because they're going to drag their feet while they need to be printing. They're going to be holding back, or they're not going to be printing nearly enough, or not recognizing the risks. And then they're going to have to come in 2 and 3 times what they expected, and then 4 and 5 times what they expected because nothing's working. There's no other tool to stop a free falling financial system. You can't go to Congress and say, can you guys come up with something? It'll take them months to agree on anything. And meanwhile, the system's falling down day by day. So the only thing that can be moved quickly is money. And it will take them many months, even if they won't agree that now we have to print money. They don't understand. They don't have any idea of the amount of money it's going to take to stabilize the system. So that means it's going to be all trial and error, month by month by month, week by week by week, trying to get to a right size policy. During that time, the things are going to continue to be falling. There'll be bear market rallies. There'll be a period where market will think maybe you did it, and it'll rally, and then look and realize, no, there's trouble ahead. and down it goes again. So there'll be, probably be two or three legs to the bear market, but people, particularly retail, but I think an awful lot of people think in terms of you either tighten or you ease. There's a whole lot of nuance in between that. How much do you tighten? How much do you ease? And we're going to be in something that it's uncharted waters. We'll have never been in something like this. I mean, 2008-9 kind of prepared us, but they're fighting that. They're saying they still don't understand what's coming and what it's going to require.